uh, or preparing contingency plans. You look at this, you will be able to look at what investors look for while they are doing financial planning. Capital efficiency, we have the risk exposure, margin structure, and we have revenue engine. You will look at this when you retire to your rooms. We have a cycle process, the 9 stage cycle. I would like you to follow through this. Okay, I missed something here. You will remind me, don't follow this. It should be having some of these stages listed. Forget about that. Forget about this. When you retire to a room, try and solve this problem. Try and solve that one. So we can proceed to I want to Chapter 10 Stocks of Production Management and Inventory Systems. When you are running production, you have to manage some things. Number one is the items within your disposal, the inventory, what is going in and what is going out. So in this case, mostly they have this industrial engineering or economics of engineers, and I think this one is economics for engineering. But industrial engineering teaches you how to plan production lines. You meet an industrial engineer and he will tell you that when I buy goods, I must convert the goods to raw materials within a given period and within this cost. So production management focuses on planning, coordination, and control of manufacturing process to ensure efficient production of goods and services. These are the roles of the industrial engineer. They do that on daily basis. So in modern industries such as manufacturing, we expect that production management achieves increasing productivity, reduce operation cost, improve product quality, and meeting customer demand on time. So production systems involve multiple interconnected elements. Say that now the layout, who does that? Industrial engineering, industrial engineers, material flow, industrial engineers, inventory management, industrial engineer, scheduling and planning. Those are the roles of industrial engineers. For you guys, you should be able to be conversant with that, since there are things that you must learn. So we talk of layout of the factory. This is how the physical arrangement of machines, workstations, storage areas, production line within manufacturing facilities. Those are the things you people are trained to know, because you want to optimize workflow, reduce material handling cost, and improve production efficiency. So what it does when we achieve a layout is movement of materials is streamlined, production delays are done away with, worker fatigue is reduced, and then operation cost. So type of factory layout, we have product layout. This one focuses on arranging machine and workstation in accordance to operations. Operation. Like now, welding, it will be grouped under one section. We say welding. Packaging is grouped under one area. If you go to factories, you realize that reception area is different. They put a wall. We go to machining section, they put a wall. They go to another section until finishing. That is how production is done. Then we have process. Process, we group them depending on processes that are done. Like in hospital, processes of testing are taken to the lab. Consultancy is taken to the consultancy rooms. That is how process can find layout. We have fixed position layout. Uh, like let me talk of a repair workshop for aircraft. You go around looking for that place. Say that the product remains stationary, but you, the employee, you will wake up in your place and go to the workstation so that you go and move around the work or the workpiece until you are done with it. And you go back. Uh, Affordable houses are not things that you can move. They finish one with in Nakuru and they move to at River. They will move workers, but the project will be there. So we have factory layout. Which normally they look like this. When you have time, you look at it. These are ways of organizing the factory. Now we move to material handling. Material handling means how do I receive, move, store, and control materials throughout the production process. That is material handling. You try to minimize cost while you are doing this and avoid delays. You also avoid damage and transport time. So the objective of this process of material handling is to ensure smooth material flow, reduce manual labor, improving workplace safety, and minimizing production time. Take note of those things. So material handling doesn't just mean your hands. We have conveyor belts, forklift cranes, automated guided vehicles, AGVs. So material flow model can be shown as such. You see the receive here goes like this, it goes that way. The receive here, it goes that way, it moves up, it is being stored. That's how material handling. You see a forklift. So it could be complex in a factory, very complex, like coming down, like spiraling, comes here, it is checked, moves here, it moves, it goes there, it goes out. It can be that complex. So we can now move to the most important thing here that makes people or startups to collapse: inventory control system. If you are weak in inventory, you better close the business before it goes into chaos. So what is actually the inventory? Inventory refers to whatever you have. Number one, the raw materials. Number two, the work that you have started, what is called work in progress, all its accessories. Number three, finished goods stored in your store. If you mess with those ones, you are messing with your inventory and you will collapse. So inventory system ensures that the organization maintain an optimal level of stock without losing it to theft, without delaying things because you are failed to manage the work in progress, or doing some overquoting, overquotations that will lead you to losses. So inventory, too much inventory leads to high storage cost and risk of obsolescence. You cannot buy. You find a nice biro in the market and then you buy 20 and you think you will use it entirely throughout your lifetime. Okay, maybe today you think the best phone is something, I don't know, let's say iPhone or something, but the next year your best phone is obsolete. So too little inventory can lead to interruption of production and lost sales. Types of inventory: we have raw material inventory, work in process inventory, And then we are finished with inventory. Inventory control objectives. Why do we do this? Maintain adequate stock, reduce inventory cost, prevent stock shortage, and then improve operational efficiency. So we need tools or systems to do this. Just in time system. Let us look at that. Is a production strategy that focuses on producing goods only when we need them and in the required quantities. Nothing more, nothing less. What you need. If somebody starts a donuts business and he knows that the market has 10 buyers, so this person will be producing 10 donuts every morning. They get bored, but they buy it, you remain with nothing, and that is the system that works for that person. Zero wastage, zero storage cost. So you will read this and be very careful about that. Pen and paper. These ones you can look at those diagrams. We move to material planning management. MPM involves planning and controlling the procurement, storage, and use of material required for production. That is material planning management. What does this tells us? It tells us that we only look for the amount of materials that is available that must be in quantities that are what you actually the correct one that you need at the right time. It shouldn't have delays at the right cost. Don't buy things thinking that tomorrow the cost will go up. Last month people were buying things thinking that because the fuel might shake their way up, you just put your money there and you buy them at high cost, then you go at losses. So function of material planning is that it helps estimate material requirements, scheduling material deliveries, monitoring inventory levels, and coordinating with suppliers. So these are your take-home points, and I want you to learn how to solve this economic order quantity. A company uses 1,000 units of material per year. Ordering cost per order is 50. Holding cost per unit per year is $2. Calculate the EOQ. You go for this formula that says EOQ is given by the square root of twice the annual demand multiplied by ordering cost and divide it by holding cost. So if you key in values is 2 times, so 10,000 times this divided by 2. Never forget this. You calculate, you get a optimal. What you need is 7 units. So you read that, and pen and paper. The rest are the questions for you to read. So we can now look at this chapter 11, investment analysis. We will briefly look at this since it is critical in economics of engineers and financial management. They form the basis of decision making, especially when you want to know that there is a new equipment, new technology, new infrastructure and projects. As an engineer, your mind should be about new. The moment you slip or you fail to learn daily as an engineer, you become useless. You become actually, the organization sees no value in you. They find ways of getting you outside that organization. Number one, they can create even theft issues while you are on duty. So for engineers, you should be able to think of new equipment, new technologies, new infrastructure, new project, upgrade, always upgrade. Every month learn new software, learn new tricks. Even if you are not employed, when you are now running your own business, you should be on your toes and be that guy who withhold the decision, the key knowledge, until when their opinion is sought after. Don't be mtu wa kuroboka roboka. Even payment cannot be increased because they easily get your opinion even without. So investment decision analysis help managers and engineers to evaluate whether a project or an asset generates sufficient returns. Are we going to make money? So total investment decision in engineering and business model include purchasing of new equipment, expanding operation, new product being developed. We have investing in renewable energy. Good people. You see this one? Even if you don't have time, you have to create time to learn this. Learn about physicists. Learn about Homer. Learn these softwares and many others. There are about 20. But learn this. Analyze for people how to install solar. It's the real, I don't want to say much about that. So investment analysis looks at the break-even analysis. You tell somebody that in the next 10 years your solar will be making you money. It will have paid off in the next 2 years. 400,000 invested in this solar system, the system of solar, the PV system, will have paid off and you will now operate without paying electricity. Cash flow analysis, annual cash flow evaluation. These are very important items. So we start with comparison of alternative investment. What do I have in my disposal? You carefully look at them and then you look at the initial cost before I do anything. How much is needed? Expected revenue. If I buy this machine, operating cost, risk level, return on investment. This one, don't ask your friend about this. Take AI analysis, go analyze videos, look at how it is solving problems in other developed countries, then bring the technology home. So we have methods of comparing investment is cost comparison. You compare the total cost. Lower cost may always win. We have profit comparison method. This method compares expected profits from each proposal or project. Then we have return of the rate of return of the comparison. You go for the one that gives you reasonable money, and then we have cash flow comparison. Yes, inflow and outflow. You look at it over time, and then you also speculate about are you going to fail. So investment comparison, you look at this allocated funds, the risk I will get, the potential gain. So you weigh them and you put the money. You will read those diagrams. We come to break-even analysis to determine the level of production or sales at which the total revenue equals to total cost. Actually, this one tells you for how long will I suffer before I start making. People say getting out of the block. Even businesses have blocks, so you get out of that. So at break-even point, profit is zero, but you have paid off your, the cost that are. So the formula for this is that you take the fixed cost, you divide it by selling price less variable cost. That is, the fixed cost is the cost that do not change with production. Variable cost is cost that vary with output or production. And then selling price is price per unit. So these formulas and these are the break-even formulas. So we will look for questions. There must have been a question somewhere here. Say that this is the fixed cost, and then the selling price is 50, and then the variable price is this, so that when they did the calculation, they got 1,000 units. You will look at those questions. For me, I have delivered the 25% that is required. So I let you guys to look for this by reading chapter 12, and you look for, I've given you 25. So you look for 75% starting today for the next 2 weeks. So I would like you to look for Beatrice Kishange, and then you sign the attendance sheet for the 12 sessions that we have had. So you will sign 12 columns of your attendance sheet, and then we meet in that exam. So have a good day, guys.